Hello, my name is Nya-Teach-E, your teacher. In this lesson, we look at the balance sheet, which is also a financial statement. What is the balance sheet? The balance sheet is usually drawn using the T format, which we will look at, and it shows a business's financial position in relation to assets, capital, and liabilities. What do we mean? When we draw the balance sheet, we will look at what the business has as assets, also what has been put in as capital, and the liabilities of this particular business. Adjustments that can be made. What do we mean by adjustments? We mean changes that may occur when you are drawing up a balance sheet. On fixed assets, if there is depreciation is a decrease in the value of a good. We get the actual value of assets by taking the old value minus depreciation mentioned. So actual value of assets when there is depreciation will be gotten by taking the old value of a particular item minus depreciation. What happens to capital? Are there any changes? Yes. To get closing capital, also called net capital, you will take the amount given as opening capital, also called initial capital, plus additional investment, plus net profit or net loss given minus drawings. So this is opening capital plus additional investment plus net profit or net loss minus drawings. The formula is given there. Are there types of capital? Yes. Capital owned, also called owner's equity, also called capital invested. This is capital that a business owner has contributed to their business. And how do we get capital owned? Capital is equal to assets minus liabilities. Number 2, there's also borrowed capital. These are resources brought into the business from outside sources. And we are saying a good example of borrowed capital is long-term loans and debentures, which we will also look at as we continue learning or revising. Number 3, working capital, resources available in the business that can be used to meet the immediate obligation of the business. And we get this by taking current assets minus current liabilities. Current assets minus current liabilities gives you the working capital. Capital employed. These are resources put in the business for a long term. And we get that also by getting total assets minus current liabilities. Total assets minus current liabilities. So the 4 types of capital are capital owned, borrowed capital, working capital, and capital employed. Now let's look at the T format, which is used to draw the balance sheet. Start with the name of the business, followed by the name of the financial statement, which in this case is the balance sheet. And lastly, write the date on which you are drawing this statement, which is usually at the end of the given trading period. On the left side, you'll have the debit entries. On the right side, you'll have the credit entries. Also, note that there is an order. On the left side, which is the debit side, start with fixed assets followed by current assets. Start with fixed assets followed by current assets. What are fixed assets? Fixed assets are assets which are expected to last for a long time, usually for more than 1 year. For example, we've mentioned land, buildings, motor vehicles, office equipment, machinery, and so on and so forth. These ones last for a longer period of time, usually more than 1 year. Then once you're done with fixed assets, move to current assets. Current assets are expected to last for a short period of time, usually less than a year in the business. For example, stationery. There's also cash at hand, cash at bank, debtors, closing stock, prepaid expenses, accrued revenues, and any other current assets. So what are prepaid expenses? These are current assets. That's why we've mentioned them there. These are current assets paid in advance for goods and services that will be provided in future. They'll be provided in future to the business. So the business has paid for goods and services that will come into the business later. For example, if I'm selling, say, pens, and I pay the manufacturer, say, 20,000 to deliver pens to my business in the month of October next month, that will be categorized as a prepaid expense. I'm going to get stationery next month. I've paid for them. I have these assets, but they're coming. They're not yet in the business. Prepaid expenses. What are accrued revenues? Accrued revenue is income the company has earned, but the company has not yet received payment for that. There is income. This is income for the business, but it has not yet been paid. For example, if someone has paid my business, paid, say, like we have agreed, they're paying me for pens that I have delivered, but they have not yet. The money is not yet in the business, but it's set to come. Accrued revenue. It's an income that is not yet paid, but is coming. And any other current assets. So we are done with the debit side. Let's go to the credit side. Start with capital. Okay, start with capital and then add any net profit mentioned, any additional investment, and then subtract drawings. So drawings are recorded when the business owner takes business supplies to use for personal use. Business supplies or money for personal use from the business. That's what is called drawing. A drawing, and then once you make this calculation here, that is when you get net capital. After you're done with capital and any other entries under capital, move to long-term liabilities. What are long-term liabilities? These are debts not expected in 1 year. You've taken, for example, as a business, a 2-year or 5-year bank loan. You have taken a mortgage. You're going to pay slowly, but it will be after 1 year. That is a long-term loan. And any other loan that you can mention there that is long-term. Then move to current liabilities. You have creditors, short-term loans, accrued expense, prepaid revenues, bank overdrafts, and any other current liabilities. What are current liabilities? Debts paid within 1 year. Long-term was for over 1 year. Current liabilities are within 1 year. Okay. For example, bank overdraft is a current liability. Okay, that we have that, and we've already mentioned creditors. Very good. We have not defined what accrued expenses are. Accrued expenses are also called accrued liabilities. That's why they are under current liabilities. These are incurred costs that have not yet been paid. Incurred costs that have not yet been paid. Not because the business does not want to pay, but because they are set to pay at a particular time in future. For example, expenses or costs such as salaries, rent for the premises, we're going to pay, but we will pay at the end of the month. That's an accrued expense. What is a prepaid revenue? A prepaid revenue is money paid to the business for goods or services not yet delivered. We said prepaid expenses are for goods or services not yet received. Now, prepaid revenues are for goods or services not yet delivered. If, again, I go back to my business that sells pens. If, for example, a school comes to my business and says, "Teacher Nya-Teach-E, we want 100 pens. we want 100 pens, and we're going to pay you today, but you will deliver these pens in the month of October. We are paying you for these pens today in September, but you will deliver them, say, on the 1st of October next month. Money is in the business, but I have not yet delivered these pens. So we call that prepaid revenue. Got it? Okay. Well, that's it. After you have input your entries on the debit and credit side, I hope it's clear. On the debit and credit side, you're going to take the totals here and here, and they should balance. They should balance. So if you find that there's an error, confirm while you're calculating, confirm your entries, and also factor in any adjustments that need to be done so that you get a balanced balance sheet. Okay, it looks like that. I hope it's clear enough. That's the T format of the balance sheet, which is pretty easy once you understand the differences that are there in the entries that are prepaid and accrued, plus when you understand what a debit and credit entry is, you'll be able to easily draw this balance sheet. I hope it's clear. We'll calculate, or we'll look at an example or two for you to have better understanding of this concept.